Your, your hosts today, your team today is going to be myself, Chuck Gouge, as your host. We have Joanne Pacina looking at our question board where you can submit live questions during the webinar. Brought to you by Tim McCutcheon, our founder and president, and the presenter today is Derrin Watson. For those of you who don't know Derrin, he is an ERISA attorney and a pension educator in solo practice in Santa Barbara, California. He received his bachelor's degree in accounting from BYU in 1980 and a law degree from the UCLA Law School. He is the author of Who's the Employer? A Guide to Employee and Aggregation Issues Affecting Qualified Plans, with the latest 7th edition now released this past year, and it's exclusively available on ERISApedia.com. He is also a senior editor of the Journal of Pension Benefits and is of counsel to the Forensic Benefits Law Center. His varied experiences range from doing stand-up comedy, yes, even about ERISA, and I'm sure some of you have heard that before, to serving as a Mormon missionary in Iran, to editing and writing books and newsletters on a variety of topics. Now, during the webinar, your lines are muted, but there is a question board available in the WebEx control panel. So you can submit questions. They will be monitored. If it's about the system or something about the webinar, we'll try to answer them live. If it's content specific, we will try to get to some of those during the webinar and or answer them at the end of the webinar. Slides and a recording of this webinar will be available on ERISApedia.com at our tab entitled Webcasts. So CE credit. A lot of you ask about CE credit. This does qualify for 1 hour of IRPA, ASPA, and NIPA CE credit. You will receive a certificate in email in several days. It will be sent to the email address under which you're registered. So please check your spam folder because it comes as an automated mail sending. IRPA certificates do take a little bit longer. It's a manual process, but please check your spam folder. But if you do have any questions or can't find it, you can email support@ERISApedia.com and we'll try to help you out. So take it away, Mr. Watson.
Greetings, welcome. Thank you for joining us this morning or afternoon. Hi, everybody. The Facebook status, it's complicated. To me, seems a perfect description of new code section 199A, the deduction for qualified business income. I'm delighted to have this opportunity to have an hour to talk about QBI. I have given a number of presentations where, the new deduction would take up 10 minutes. Obviously, I could do a lot more in 50 minutes. And this, I just approved a program where somebody's going to be talking about it for 2 hours. There's a lot of stuff here. And for those of you who've heard me give the shortened 10-minute presentation, you'll find some differences between what we're doing today. You ought to, between what we're doing today and what I've given in the abbreviated version, because I have more time to get into the details here. The new code section is 199A. It went into effect at the beginning of the year. So this 2018 will be the first year you can get the deduction. And what it offers is a deduction of up to, and you don't necessarily get this, but potentially 20% of your qualified business income. So you have a business that generates $200,000 as bottom line profit, and you can get a $40,000 deduction depending on the circumstances. That's worth spending some attention on. It is available to sole proprietorships, partnerships, S corporation shareholders, and estates and trusts. Now, I want to pause there because I think what is not on that list is very important to note. What you don't see there is C corporations. C corporation shareholders do not get the benefit of the 199A deduction. Why? Because Congress felt like they had already given the C corporations what they had coming to them. They lowered the top marginal rate for a C corporation down from 35% down to 21%. So for the rest of us that aren't C corporations, this is our consolation prize. We don't get that rate reduction, but the C corps get that. But I'd like you to think about that for just a moment. I used to be in a C corporation. I was a law partner in a Beverly Hills law firm shortly after I started practicing. And we were organized as a C corporation. And as with many small professional corporations, our goal, our plan was to create a taxable income of 0 at the corporate level every year. And we were pretty darn good at that. I'm sure most of our audience has been a part of conversations with employers seeking to achieve that result. Well, if the C Corp has a taxable income of 0, they derive no benefit from the rate reduction. In other words, the tax rate could be 100%. If your taxable income is 0, it's all the same. So for small companies, and I don't know about you, I've spent 93.2% of my working life dealing with the small plan market. For a small corporation that is zeroing out their income every year, A, they don't get the benefit of the rate reduction, and B, they don't qualify for the new 199A deduction. And so one of the things this suggests is maybe you don't want to be a C Corp anymore. Now, when I started practicing, and I've been dealing with ERISA since the late 70s, when I started practicing, the deck was stacked against self-employed individuals. If you had a KEO plan, as they were known back in the day, you had a number of disadvantages compared to your incorporated brothers and sisters. And, you know, we actively encouraged our clients to incorporate so they could take advantage of all that was there. And now, here we are 40 years later, and the pendulum is shifting the other way. And maybe a C Corp isn't the way to go. I don't want the tax tail to wag the dog here, but at least that's worth considering. Now, before I go on, a very important point. This is a new statute. It is a complex statute, and there is a lot we are looking for in terms of guidance from the IRS, in terms of filling in some of the blanks and helping to clear up some of the ambiguities that are inherent in a statute as complex as 199A is. We don't have that guidance yet. My guess, I've heard, we'll see, maybe we'll get it in June. In other words, I don't think it's that long, maybe another month before we have that guidance, June, early July. And If so, it may be well to postpone any radical moves until we get that guidance and know exactly what we're dealing with. But for the moment, the thing this slide tells you is if you're a C Corp, maybe you want to consider something different. To be more precise, I said that your Section 199A deduction could be up to 20% of your qualified business income. More precisely, it is 20% of the lesser of your qualified business income, and we'll talk about some limits on that later, or your taxable income. And when we calculate taxable income for this, and this goes throughout the program today, when we talk about your taxable income, it is before taking into account the 199A deduction, and before you take into account, without or subtracting out, I guess is the best way to refer to it, your net capital gains, your long-term capital gains reduced by your short-term capital losses. Those things don't enter into your taxable income. Because, hey, you're already getting a benefited tax rate on your net capital gains. So, but your QBI deduction will in no event exceed 20% of your modified taxable income. Now, let me give you a couple of examples. Suppose I have somebody who is a business owner and they make $300,000 a year. That's their qualified business income. And their taxable income, before taking into account the QBI deduction, is $250,000. Their 199A deduction is $50,000, which will reduce, of course, their taxable income down to $200,000. By contrast, suppose their qualified business income is $200,000 and their taxable income is $300,000. How does this happen? Well, because, yeah, they've got a Schedule C business, but they have some investment income. Maybe they have some W-2 wages. They have other income sources besides their qualified business income. It may be a married couple, and the wife has her business, and the husband is a W-2 employee somewhere. You could have a variety of circumstances where the qualified business income will be greater than the taxable income. So my example 2, the QBI is $200,000, the taxable income is $300,000. The maximum deduction is $40,000, 20% of $200,000. Interestingly enough, this deduction can be an itemized deduction, appearing on Schedule A, but if you don't file a Schedule A, you don't itemize, you take the standard deduction, you can still deduct it anyway. So you can deduct it on top of taking the standardized deductions. Congress, in enacting their tax reform bill, really, how can I put this best, skewed things in favor of going with the standardized deduction. They did this in a couple of ways. Number one, they increased the standardized deduction. It's now up to $24,000 for a married couple. They also reduced some of the itemized deductions that you would be able to claim. For example, your home equity line of credit, the interest on that is no longer deductible. Not all of your state income taxes are deductible. So they took away itemized deductions and they put more fuel into the standardized deduction, and I think we're going to see a lot more people not filing Schedule A once this fully settles in. Well, you will still be able to claim this new deduction. This deduction is available for 2018, 19, 20, 21, 22, 23, 24, 25. That's it. At 2026, it disappears unless Congress chooses to extend it. That's true of a lot of things in the tax bill. So what is qualified business income? It is determined separately for each business. There are some various limits we're about to talk about, and those limits are applied separately for each business. So within each trader business, it is all items of income, gain, deduction, and loss to the extent such items are effectively connected with a trade or business within the United States. So, one of the first things to note about this is the phrase trader business. This is a big one from a tax standpoint. So this, from what you would see on a tax return, this is your Schedule C, this is your Schedule F for farm income, this is your Schedule K1 for partnership. This is a trader business, as opposed to, let's say, rental real estate that you might happen to own. It's a trader business within the United States. So a foreign trader business isn't going to qualify for it. One interesting note is that if you have a loss in year one, it will carry over and reduce your QBI in year two. Congress was concerned that people would try to manipulate their deductions. So I'm going to prepay most of my bills, pay them all this year for the next 2 years, and I will get a net operating loss, which I can, offset against other income. And then next year, I'll be able to say, oh, look how much QBI I have, and take advantage of the 20% deduction in that year. And they say, we're not playing that game. If you have a loss in year one, it will reduce your QBI in the following year. Now, so I will frequently refer to qualified business income as your bottom line Schedule C, your line 14 on your partnership K1. But there's some other deductions that we're waiting for guidance. Here's part of what we're waiting for guidance on, that I think come within the definition. Look with me again. All items of income, gain, deduction, and loss effectively connected with a trade or business within the United States. Well, look at line 28 on the adjusted gross income. Self-employed, simple, and qualified plans. So this is your deduction for your retirement plans. Does that reduce your qualified business income? We don't have an authoritative answer. I'm betting the answer is yes. I think we make a really good argument that's effectively connected with the trader business that's going on. Even though it doesn't appear on the Schedule C, I think we would take that into account. Now, one point, and let me go back a couple of slides here. The QBI deduction is 20% of the lesser of my qualified business income or my taxable income. We can ask whether, and we'll wait to know for sure, whether my Section 404 retirement plan deduction reduces my qualified business income. But it sure as shooting reduces my taxable income. That's the whole point, ladies and gentlemen, is it's going to reduce the taxable income. So I know that's going to be reduced by it. All right, Derrin's interpretation, I think it's going to reduce the qualified business income as well. Two other items I've got here. 1/2 of the self-employment tax. This is done to make self-employed individuals on a parity with incorporated businesses. To me, that's effectively connected with the greater business. Also, line 29, the self-employed health insurance deduction. We'll find out, hopefully in a month or so. But I think all of those are logically effectively connected with the trade or business. All right, this is a quote from the statute. Qualified business income does not include reasonable compensation paid to the taxpayer by a qualified business for services rendered to the trade or business. So let's talk about what that means at the least. If I am an S corporation shareholder and the S corporation gives me a W-2, and that W-2 is deductible, translation, it's reasonable compensation, it's not qualified business income. So if I have an S corporation, I could have two sources of revenue from the S corporation. One of them is my share of the undistributed net income. And the second is my W-2. My W-2 does not qualify for the 20% deduction, period, end of statement, unless it's unreasonable, and I don't see the IRS going that way, do you? Now, I don't have an S corporation. I'm a sole proprietor. I file a Schedule C. Isn't that wonderful? I don't give myself a W-2. I can't give myself a W-2. I'm not an employee. And, you know, I ought to be, like any other Schedule C business, paying quarterly estimates and paying my self-employment taxes. Reasonable compensation is not included in QBI. Question: might the IRS take that as some license to say, we will treat you as, pick a number, 50% of your bottom line Schedule C, we will treat as being reasonable compensation for the services of the sole proprietor? I have no idea. This is one of the great concerns out there about what this guidance may subsequently show. But right now, in the absence of that guidance, I really like being a sole proprietor in terms of being able to take this 199A deduction. Let's go to B for a moment. Any guaranteed payment described in 707C paid to a partner for services rendered. I'll focus, there's a similar line for 707A. A guaranteed payment for services rendered is like a W-2. It's like a salary paid to a partner. Okay, so way back when I told you I was in a C corporation. And yeah, at the end of the year, we would take the profit that was there and we would award ourselves bonuses in accordance with our share interest. and divvy it up. But I also had a salary. And particularly in the early years of my partnership, the salary was what I lived off of. Not so much the bonus that was my share of things. Well, the same type of thing goes on with the partnership. Those guaranteed payments are not qualified business income. So, let's see. I'll come back to the S Corp for a moment. This, on the left of the screen, is a list of items that shows on a Schedule K1 for a partnership. And notice, if you will, line 1 is ordinary business income or loss. Line 2, your real estate income and so forth. And then line 4, guaranteed payments. And down at the bottom, line 14, self-employment earnings and loss, there's a place there to put in a code. Line 14 with code A is what we pull off as the net earnings from self-employment. This is the basis of earned income. This is the basis of planned compensation. Well, that line 14 is the sum of, say, lines 1 through 4. I'm oversimplifying, but the guaranteed payments get lumped in with the ordinary business income or loss. Let's try a situation. Sue is a new partner in a law firm. I always thought that Sue was a great name for a woman attorney. Sue is a new partner in a law firm. She receives guaranteed payments of $200,000 a year plus 4% of partnership profits. Let's suppose the partnership profits are $1 million. So her 4% is $40,000. So line 1 of her K1 is going to be $40,000. Line 4 is going to be $200,000. And her self-employment net earnings are $240,000. That line 14 number is what we base her planned compensation on. But her qualified business income is only the $40,000. It's only her interest in the profits, not the guaranteed payments, which take the place of wages. Did I mention I really enjoy being a sole proprietor? Let me go back for a moment to S corporations. Mary's an employee of her S corporation. The S corp pays her W-2 wages of $100,000. It's reasonable comp, and we can base a retirement plan contribution on that $100,000. And her S corp K1 reflects an additional $200,000. We cannot base a retirement plan contribution around that $200,000, but that $200,000 is what qualifies as qualified business income. Now, once again, while I'm waiting for the IRS to tell me what they plan to do with this reasonable comp line, might they reallocate the numbers and say, well, Mary, we figure that your reasonable compensation for your services was really $250,000, and your profit from the business is only $50,000. I don't know. That's pure speculation at this point. But again, Mary has this W-2, and I don't. So I don't have any guaranteed payments. I don't have any compensation. Life's good for me. So my qualified business income is my bottom line Schedule C, right now at least. There's a lot to say for being a sole proprietor. Very important. This may be, this and the couple of slides that follow it, the most important slides of the program. There are two limits on qualified business income. These limits apply if your taxable income is high enough. To be more specific, the limits are irrelevant. They disappear if you're married filing a joint return and your taxable income, and again, this is taxable income before the QBI deduction, net of capital gains. If your taxable income is $315,000 or below, if you are not filing a joint return, so you're single, you're head of household, you're married filing separate, cut that 315 in half, so it's 157. Now, where did they get this number? Answer, it is the dividing line between the 24% bracket and the 32% bracket on your tax, on the new rate schedule. If your taxable income is below that level, these limits don't apply to you. Now, if your taxable income is above 415 married filing joint, or 207,500 if you're not filing a joint return, then these limits apply fully. So that's $100,000 on the married filing joint, $50,000 for the separate return, and in between the limits phase in. So there are two limits. The first is there's no qualified business income deduction at all. Your 199A deduction disappears entirely if you're in a specified service, trade, or business. And number two, your QBI deduction is limited based, if you aren't in a specified service, based on your wages and depreciable assets. Okay, so if you're in a specified service, trade, or business, you don't get the QBI deduction. Here's the list from the statute of the specified service, trades, or businesses: health, law, accounting, performing arts, consulting, athletics, brokerage services, investing, investment management, dealing in securities, and any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. Suppose I closed my law practice, I stopped being of counsel to my friend Eileen Frenzy, and I said, you know, I am a professional author and educator. That's what I do. I write books and I give seminars. And that's what I do. So I'm not in the field of law. I'm an educator. I'm an author. Any trade or business where the principal asset of such trade or business is the reputation or skill. They got me. There are two that we normally think of on a list of services that were deliberately excluded by Congress: engineers and architects. They were deliberately excluded from the list. But you know, when I look at this list as a qualified plan practitioner in the small plan market, I don't know about you, but these are my peeps. These are the people who have paid my mortgage for years. These are the people that I serve. And so if you're in the small plan market like I'm in the small plan market, most of these folks are going to be profoundly affected by the fact that they're in a specified service, trade, or business. Now, let me go back. Now that we understand this, all right? So the doctors, the lawyers, the accountants, consultants, all of those are in specified service, trade, or businesses. If you're in a specified service, trade, or business, and your taxable income is below $315,000, if you're filing joint, $157,500, you don't care. You're good. You get the deduction. And if it's above $415/207, you're toast. You don't get the deduction. And in between, it phases out. Wow. That's the key concept. So if I've got a doctor whose qualified business income is $500,000 and the taxable income is $450,000, the 199A deduction is diddly squat. And if I've got somebody who owns a restaurant chain and let's, I'm not sure what they're going to do with this. The skill of one person is going to be what focuses. Let's take out the Wolfgang Pucks of the world. But I own a chain of restaurants, and my qualified business income is $500,000, and my taxable income is $450,000. My 199A deduction is $90,000. Wow. Now, this is an area where we can help. Suppose you've got a prospective client who's a single emergency room doctor, sole proprietor, qualified business income is $250,000. Taxable income is $210,000. Now, if we stop there, if the limitation on a specified service, trade, or business didn't apply, he'd be able to take a $42,000 QBI deduction. But, no question, he is in a specified service, and he's single, the limit is $207,500, dang, he gets nothing. Have I got a plan for you? We're going to give you a 401k plan. We're going to fund it to the tune of $53,500 and thereby drop your taxable income to $157,500. And now the doctor can claim a QBI deduction for $31,500. He doesn't get the $42,000 that he got before, but he gets a lot more than the zero he was looking at. Plus, he gets to deduct the $53,500. Now, if this is your goal, this is your plan, don't make the contributions to the plan Roth. Your goal is to reduce the taxable income. Roth isn't going to do that for you. Suppose I've got a married doctor with income around, let's say $420,000, and I put in a cash balance plan and contribute over $100,000. It's the same deal, all right? We're going to get the deduction for the cash balance plan, and we get over $60,000 of QBI deduction. Woo! That adds real power to the notion of you ought to set up a plan. I have seen presentations on 199A that said, you tell this doctor to make a charitable deduction, and yeah, that'll work. If he makes a charitable deduction of $53,500, itemize it as on the Schedule A, it'll do the same thing. But, and if he wants to give the money away, I'm not going to stop it. But I don't know about you, most of the doctor clients I have would rather keep the money for themselves, which means putting it in a plan for their benefit. Now, that's the first limit. Suppose I get past that limit. Suppose I have some business that is not a specified service trader business. For example, my restaurant owner. The deduction, and this is computed on a business-by-business basis, is the lesser of 20% of the QBI or the greater of 50% of the W-2 wages associated with the business, or 25% of the W-2 wages plus 2.5% of the depreciable assets. Did I mention something about this being complicated? Goodness gracious, yes. The W-2 wages are the wages connected with the QBI. It includes wages to the S corporation shareholder, but it isn't just the shareholder's wages. So if you've got a bunch of employees in your business and you're paying them salary, that counts. It's their W-2 wages, not their retirement plan contributions, that's going to count here. If we're talking about an S corporation or a partnership, it is your share of the wage expense. So suppose I've got two 50-50 partners, and the wages for the employees, remember, the partners don't get W-2s. The partners may get guaranteed payments, but they don't get W-2s. Let's suppose the W-2 cost for the employees is $300,000. Each partner then gets half of that, $150,000. So the partner then compares that $150,000 to their qualified business income. And if their QBI was $400,000, but their share of the W-2 was only $150,000, and you can only claim half of that. It's half of the W-2 wages. Ooh, that's going to really hurt. In order to be able to claim those W-2 wages, interestingly enough, you have to file the W-2 timely, not later than 60 days after your filing deadline. So let's suppose we're dealing with the sole proprietorship that is not in a specified service trader business with $700,000 net income a year. And the taxable income is $1 million. This is a married couple filing a joint return. But the employee wages are only $80,000. The 199A deduction is the lesser of 20% of the QBI, $140,000, or 1/2 of the wages, $40,000. Ooh, there's a problem. Now, one approach for this circumstance is to incorporate and be an S corporation. Why? Because you can give yourself a W-2 and that will count. So in this case, we'll pay the owner a salary of $150,000, assuming the owner is in the business. This is reasonable compensation. We're going to pay the owner a salary of $150,000. That means the qualified business income now is down to $550,000. 20% of that is $110,000. The total W-2 wages now are $230,000, $80,000 for the employees, $150,000 for the owner. Total is $230,000. And 50% of that is $115,000. The owner gets the $110,000 QBI deduction. So S corporations can be a plus or a minus. There are circumstances where you say, gee, I don't think this is a good idea. There are circumstances where you say, well, having the S Corp, having the ability to pay myself the W-2 is my salvation. All right. The other possibility besides 50% of your W-2 is, of the total W-2, pardon me, is 25% of the W-2 plus 2.5% of the unadjusted basis immediately after acquisition of all qualified property. What does that mean? This is the purchase price of your depreciable assets used in the business. It is not the depreciation expense. It doesn't alter based on the adjusted basis. It's essentially 2.5% of the purchase price of your depreciable assets, and the depreciable assets include tangible property, so to the extent you're amortizing intangible property, that doesn't count. Where the depreciable period hasn't ended by the end of the year, and the depreciable period is at least 10 years after it's placed in service. So for a good long while, you can claim that, but it takes a lot of depreciable property to make up for the wages. Let's suppose I have a business where the W-2 wages are $100,000. Well, the maximum QBI deduction then is going to be 50 grand. But let's go to the formula where we're going to use 25% of wages and 2.5% of the depreciable assets. I have to have $1 million in depreciable assets to be able to get to that same $50,000 maximum QBI deduction. There it's going to be based on the partner's share of the depreciation deduction. Now, one of the points I mentioned early on is that we're not certain whether the retirement plan contribution reduces your qualified business income. But we are absolutely certain, as I say, that it reduces your taxable income. I think it does reduce your qualified business income. We'll find out when the IRS weighs in on the subject. And it can create a situation where my retirement plan contributions are reducing my taxable income by not quite as much because they reduce my qualified business income deduction. I'm really only getting, in effect, the benefit of 80% of my retirement plan contribution. And so isn't that going to be hurtful for business? Isn't that going to be hurtful for employers wanting to set up retirement plans? And my answer is I don't think it should be. It isn't just that we are giving you a tax deduction today on the contribution. We are giving tax deferral on the earnings of that contribution, so long as the money's in the plan. And that is valuable in and of itself, and I think more than makes up for the loss that comes with the QEI. But if this is a real concern for you, then go ahead and go with Roth. If you've got a 401k plan, remember you can use in-plan Roth rollovers and make it all Roth. And if that's what you want to do, so it doesn't reduce your taxable income and it doesn't reduce your QPI, be my guest. However, there are folks who really want to reduce their taxable income to get it below the threshold. S-corps, we have long had this dilemma that your W-2 is the basis of your retirement plan contribution, but your K-1 escapes payroll taxes. And there has long been this desire to maximize the K-1 to minimize the W-2 so as to escape payroll taxes. Response number one, the IRS is wise to this. They have been wise to it for a number of years. And number two, I can't make a retirement plan contribution with regard to the K-1. Well, now I add QBI into the mix. The low compensation means not only lower FICA taxes, but also a higher QBI deduction, where higher compensation means a higher retirement plan contribution, but I've got the FICA taxes and the lower QBI to go with it. So it's a dilemma. Again, there are some folks that are really well served by going to an S-Corp under this regime because they really want the W-2. And I'm sitting here as a sole proprietor, so grateful I'm a sole proprietor. So there are three kinds of business owners. The green light, your taxable income is below the 32% bracket. You're below 315 or 157.5, or you're not in a specified service trade or business, and you have lots of W-2 wages that you're paying your people. If you're in the green light territory, you get the full QBI deduction. Red light, you are in a specified service trade or business, and your taxable income is at $415,000 for joint return, half of that 207.5 for a single, and you're not getting it. And between those two, the yellow light, you're in phase-in territory. One other possibility just to consider, and this is counterintuitive for me. For years, I've looked at married filing separate and said, gee, why would you do this? Well, I now have a situation where married filing separate could make sense. John and Mary are both doctors. They're sole proprietors. Each has their own practice. They're in Florida. There's no state income taxes to complicate things. It is a separate property jurisdiction. John's Schedule C shows $200,000, and he has a $50,000 solo K. Mary's Schedule C is $400,000. She has $100,000 in cash balance plan. They take a standard deduction, $24,000. Their taxable income is $426,000. They don't get the QBI deduction at all. So John files a separate return. His Schedule C is $200,000. The solo K is $50,000, and he gets a standard deduction of $12,000. His taxable income is only $138,000. He can get a 199A deduction of $27,600. His wife is out in the cold, but he at least can get the deduction. And at 24%, that's decent money. Now, one thing you could do, make 18.5 of deferrals Roth and bring the taxable income up to 156. You can still get the QBI deduction, only now because I've turned part of it into non-tax, non-deductible, my 199A deduction has gone up to $31,300, 20% of my taxable income. One of my most frequently asked questions, does the 199A deduction affect your net earnings from self-employment, your earned income, which is the compensation for a self-employed individual? I think it's pretty clear. The answer is no. So your retirement plan compensation for the self-employed individual, the partners of the sole proprietor, is going to be the same before the new law, after the new law, either way. But planning for it could have an impact. And obviously, the retirement plan contribution affects the 199A deduction. That wraps it up, and I don't see any substantive questions here. So, Chuck, I'm going to kick it back over to you.
Okay.
Thank you, everyone. It's been great having you.
Yeah, thank you, Derrin. Thank you very much, and thanks everybody for attending. I know there was one question that just came in. You will be able to download a copy of this presentation as well as a recording of it if you wish to watch again on our website, erisapedia.com, under webcasts. We're going to stay online here for just a couple more minutes if you're interested, and you can see a quick, brief demo of Derrin's new title on our compliance library. If you can't stay online, please give us a call or write us an email at sales@erisapedia. We will certainly give you a private, personal, one-on-one demo, and maybe even set you up with a trial ID if that's what you want. So thanks everybody for attending. Have a great rest of your day, and if you stay online, I'm going to switch over and show you a quick demo. Okay, so here we are at the erisapedia.com platform. Here is Derrin's new title. Well, not so new title, but new edition of his title. I think it's the 7th edition. Oh, by the way, did Derrin mention he's glad he's a sole proprietor? I think he did. But anyway, his title is 25 chapters plus some great content in the appendix. It's all searchable with our search bar. Every chapter has a table of contents, and you'll notice that it's written in question and answer format. We do have links to hyperlinks to other sections, even to benefits link articles that he's written in the past, as well as court cases, code sections, regulations, etc. The little question mark is kind of nice. It allows you to submit a question to be answered by Derrin. If this content is still a little bit vague for you, you could cut and paste it and say, Derrin, please help me understand what yes means, or what have you. Love to give you a quick demo if you're interested of a one-on-one demonstration. The Qualified Plan e-source is also the title written by Eileen Ferenzi and Tim. It has a really good content, sort of the soup and nuts of qualified plan compliance issues, with some other great content in the appendix. And we even have full text of all the code regulations and so forth from the IRS, DOL, and PBGC. Inside the IRS statutes, you will even find code section 199A, where you can go to all this stuff that Derrin's just been talking about. And the government has ensured a full employment act for lawyers to help interpret for the next years to come. Thanks everybody for attending. Remember, you will get CE certificates in your email here shortly, in the next few days, or this coming week anyway. IRPA does take a little bit longer, so please be patient with that, and check your spam filters, because a lot of these do get caught in your spam filter if you haven't already received a certificate in the past. If you have any questions, comments, please write us at support@erisapedia.com, or give us a call at our main number, which is at the bottom of the screen here, 612-605-2266. Thanks everyone, and have a wonderful day.